Welcome to Align Spotlight, where you meet your manager. Hey Baird family, this is AMR's Jason Cooper, and welcome to Align Spotlight, where you meet your manager. The investment landscape over the trailing 12 months has been adamantly focused on return generation. Risk has morphed into a four-letter word. Today, I'm excited to introduce a PM and firm that prioritizes risk-averse investing. Chad Baumler is the Vice President and Co-Chief Investment Officer of Nuance and is co-owner of the firm. Chad is the co-portfolio manager for Nuance Mid Cal Value. He also focuses his analytical skills on the energy, financial, and real estate sectors. Chad has over 14 years of investment analyst experience and 6 years of portfolio management experience using a classic value approach. Chad graduated from the University of Northern Iowa with a Bachelor's of Arts in Finance and has an MBA with a concentration in finance from the University of Texas. He's a CFA charter holder and a member of the CFA Institute. I hope that you'll stick around for our after show, where I speak with Align PM Aaron Benson to discuss a unique process that our team uses, which resulted in our discovery of the Nuance Mid Cal Value Fund. Enjoy. Hey Chad, thanks for joining us today.
Hey, great to be here, Jason.
So your co-CIO, Scott Moore, founded Nuance in 2008 despite already running a successful mid-cap value product. What are the founding principles that he wanted to enshrine at Nuance, and how is it different from peers? And also, what is it about that mission that attracted you to Nuance?
First of all, just on kind of we could call them the founding principles, or I think of them as the three interesting differentiators of our firm. The first is that we as a team are exclusively focused on risk-adjusted returns over cycles. And so when I say risk-adjusted, what I mean is a Sharpe ratio, not so much an information ratio, but returns and volatility. That's what our team's focused on each and every day. Second is that we run concentrated portfolios, and really all of our products, including our mid-cap value strategy, would be concentrated versus benchmarks and peers. And then the last one is that we as a firm from the very beginning, when Scott Moore founded the firm, as you mentioned, back in 2008, with just a few dollars, his goal was to always maintain a nimble AUM size at the firm level. And we've been able to do that when you look at our AUM versus most of our leading peers. Definitely, less AUM, greater ability to be nimble with our stock picks and actually run those concentrated portfolios that I mentioned. So those are kind of the differentiators as a firm. If I think about joining the team, why I decided to do that, I wanted the opportunity to do something different and really something special for clients. And I wanted the chance to be on a team where the clients, in certain markets would say, wow, what are you all doing, in a positive way, and then also realizing that, hey, there's going to be markets where they're going to say, oh my gosh, what are these guys doing?
And as you mentioned, with your principles, it's all about the risk. So Nuance places a tremendous emphasis on risk, and maybe you could speak to how competitive analysis reduces security-specific risk.
Yeah, so Jason, when it comes to risk, I know a lot of teams, a lot of investment processes talk about risk, but I can tell you we do place just a ton of emphasis on risk here at Nuance. And that's important in markets like a year ago in March of 2020, when everybody cared about risk. It is just as important today in July of 2021, where nobody cares about risk. Our team is just has a laser-like focus on risk, and just to be clear, risk to us is permanently losing our clients' capital. It's not not looking like the benchmark or some of the other risks that are out there. And honestly, there's only really three ways to permanently lose our clients' capital. Number one is you can pay too rich of a multiple for a company. So let's say we think a company's worth 12 times EBITDA and it ends up being worth 8. If you throw a little leverage on top of that, that could be a 30 or 40% haircut to what we thought the company was worth, or more. That's the first way. Second way is if we misestimate the earnings power of a company over time. So let's say we thought the normalized earnings power of a company was $1 per share, and it ended up being 50 to 75 cents. Well, once again, that could create a loss of our clients' capital. And then the third way is if you just pick the wrong companies to begin with. And this is the biggest one. This is a situation where a company's future because of some sort of major competitive transition ends up being dramatically different than what we expected on all fronts. And basically it's buying the leading horse and buggy manufacturer when the automobile is about ready to disrupt the industry. That sort of scenario. And this third scenario is where the founder, Scott Moore, and myself have made the majority of our investment mistakes over time, and really represents what's commonly referred to as a value trap. And that's where you buy something because it looks cheap. But inherently, when saying it looks cheap, that statement is a relative statement. You're saying it looks cheap versus something else. And that something else tends to be in the past: old sales, old earnings, old EBITDA, old book value, old something. And when these major competitive transitions happen, the history ends up being 9 times out of 10 irrelevant. And so we utilize an investment process that helps us to mitigate all of these 3 risks, but we do have a particular focus on that competitive transition risk. And really the key here is that we're investing in companies for our clients that have leading market share positions, generally number 1 or number 2 type market shares in their sub-industries or areas of expertise. They have reasonably certain competitive futures, which is very key. We stay away from the 50-50 bets with our clients' capital. If we don't understand what the next 5 years look like, how on earth can we understand into perpetuity, which is, of course, what the stock price represents? So by having that focus at the front end of our process on risk to business models, we've been able to sidestep many of the value traps that our peers and benchmarks get stuck in. Not all of them. We're certainly not perfect, and we don't claim to be, but we have been able to sidestep many of the classic value traps that have happened over the last couple cycles.
Great, thank you. That was really helpful. You've also been putting out some really interesting proprietary research over the last couple of years, particularly around demographic trends and food industry trends. Can you talk about one of those studies and how it impacted an investment thesis?
Yeah, I can, and this is an interesting aspect of what we do, Jason. We're never happy with what we have. We always want to make it better, and this is one of the many process enhancements that we've made over the last few years to our process. The backbone of our process is unchanged, and it's been unchanged for a long time. But we've got 5 steps to our investment process, and we're always looking for ways to improve or to tweak that to make it better. And this is one of those areas. We started a few years ago identifying what we call the nuance megatrends, which these are basically, they end up being about 15 to 20 major disruptive forces that are out in the world. Every year we meet as an investment team formally, and we all bring our ideas and we discuss it as a team and identify all the major disruptive forces that could affect our Nuance universe companies at some point in the future. And then we decide which one of these megatrends which ones we want to study as the highest priority. A study that we recently completed was on global population growth. And I know all of us have read many articles about global population growth, and the summary of those articles is that developed world is shrinking and emerging markets are growing when it comes to population. That's the general tone of about every article I've read. Well, we actually dug in further. We studied regions, major countries, and studied them in a variety of different ways, and sliced and diced the population in a variety of different ways, and really found some pretty interesting conclusions. And I'll just share one of them today because it's very relevant to our portfolio and what we hold right now, is Europe. So Europe is expected, has went from slow growth in population, expected to flatline over the next decade. And so all other things equal, that's a negative change. If you have flat population growth, that is one of the levers to growth that you no longer have within your algorithm. And so if we would have stopped there and said, okay, companies with European focus now we're gonna ding them for having flat population growth. That means volumes could be tough. Well, what's interesting is when you dig into the numbers for Europe, that is true. Population growth is expected to be flat over the next 10 years. However, when you dissect based on age bracket, there's actually sleeves of the European population that are expected to grow over the next 10 years. And in fact, the 65 and older population is not only expected to grow, but it's actually accelerating to 1.8% a year over the next 10 years. Our expectation. So companies like Smith and Nephew in Bayersdorf, which are in the portfolio today. Smith and Nephew is a leader in knee and hip replacements, and Bayersdorf is a leader in beauty products, including many products that are aimed at that 65 and older demographic, anti-aging creams, lotions, etc. It would have been very easy to stop and just say, well, Europe's going to be flat, so anybody with European exposure, we're going to have a little less conviction in. In fact, it's the opposite for those two companies. They actually have products that are geared towards a part of the European population that is about to excel and grow a little bit faster. So that's just an example of how we're using these mega trends to help us either enhance conviction or there's scenarios on the other side too where we've studied things and decided, you know what, maybe we used to like this one a lot and we like it a little bit less because of it.
It's an awesome study. Thank you for sharing that. You already highlighted, at the security level, the risk of investing in something that lacks a competitive advantage, but you incorporate risk into the investment process also when it comes to portfolio construction. At the portfolio level, how do you define risk, and how does that impact like the position sizing and utilization of non-common stock holdings such as fixed income products or cash?
So we definitely do focus on downside risk in a couple places. The first part is at the front end of our process through what I just described on the competitive analysis. The second part is at the security level in quantifying downside risk. In downside protection, when it comes to portfolio construction, is very important to our team. When you study our historic calendar year results, capital protection in tough markets has been a hallmark of what we do. And what I'm about to say is a very simple idea, but it's actually one of the key value adds to our investment process. And that is for every one of the companies we track. And we've got roughly 250 companies we track over time. Those are the ones we're focused on, which means there's about 4,000 other companies we don't care about at all. We focus on this 250 and we set two very distinct price targets for these companies. We set a fair value price target, which is what everyone else is trying to set too, but we feel like we've got an edge through our proprietary research and our proprietary earnings estimates that we use, our normalization process. But nonetheless, it is a fair value price target. But we put an equal, if not greater, emphasis on what we internally refer to as a downside price target. And what this downside price target represents is, in our minds, it's kind of a 2 standard deviation event, not 3 standard deviation end of the world, but 2 standard deviation. Market sells off big time. Sub-industry is despised by the street, and a few idiosyncratic issues pop up all at the same time. Where could that stock trade down to basically on a really, really bad day? And this downside price target is updated generally quarterly. However, whenever there's new information that comes out, we would update it as well. So quarterly updates roughly. And the very simple example of this, Jason, that I always give clients is we just think this is such a crucial piece of information to making good risk-adjusted decisions. So I've got 2 companies that I study, and they're both in the same sub-industry, and they both have similar competitive positions. And they're both trading at 10. This is hypothetical, and they're both worth 11. Okay, which one should we buy? Well, Jason, you and I have been in the industry a long time. We would be qualified to make decisions like this, but it's honestly very, very unclear. Both companies have the same amount of reward. Which one do we pick? Maybe I have a bias towards A, you have a bias towards B. Maybe someone else might say, hey, they both look good right now. In today's market, a 10% upside looks great, so let's do both of them. And so it's hard to come to a conclusion. But if I, as the analyst, can go back and I can dig in and study the sub-industry over the last couple cycles, think about the downside scenario for those specific companies, and think about what happens to the balance sheet, what happens to maybe some of the off-balance sheet liabilities in that sort of downside scenario. And I can come back and say, hey, with a reasonable level of confidence, stock A on a bad day could trade from 10 to 8, and stock B could trade from 10 to 5. Well, then all of a sudden the decision is crystal clear. They both have the same reward. Stock A is less than half the risk, downside risk of stock B. So we're going to pick A. And that's what we do each and every day. That's every morning we meet as a portfolio management team, and we are constantly optimizing the risk and the reward in the portfolio, seeking to maximize reward and minimize risk. And that minimizing risk, I know a lot of people say things like that. It honestly it's half of what we do. It's a focus of the team, and it doesn't matter until all of a sudden it does, and our work's already done ahead of time. So that's how we focus on the downside risk. It's how we incorporate it into our investment decisions. So really, at any given point in time, I can tell you, the upside and the downside potential in the portfolio, as well as all the individual holdings. What's interesting is you mentioned some of the other investment types that we have in the portfolio: cash, preferreds, convertible preferreds, merger targets, even international stocks, some of the things that might look a little different than some of our peers' portfolios. And honestly, it's the exact same process. Everything we invest in has a reward and has a risk. So today, cash is +0 -0. Okay, cash isn't yielding anything. 2 years ago, cash was +2 -0. Our preferreds, we have very specific risk rewards for each one of our preferreds that we invest in. Our convertible preferreds, which have an equity exposure inherent within them, have a very specific risk reward for each one of our investments there. So it's the same process. We calculate upside, we calculate downside, and then we each and every day try to optimize at the portfolio level.
It's a really differentiated process, and you know, providing the audience some context. You've been doing this for quite some time, and you've been through different markets. And I was hoping you could just share from a risk perspective, how do you describe today's market, and how do you feel about your portfolio's risk?
So it's a great question. So I'm going to make some comments here, and I'm going to use the word market. However, I do want to clarify up front that when I talk about the market, it's really Nuances market. It's our universe to 250. And so it may or may not be exactly correlated with the overall stock market. Pick your benchmark. But over time, what I would tell you is it has been correlated from our experience. So today our list is overvalued by about 40%, with just under 75% downside potential. So what that means is on a really, really bad day, technically our list could go down 75%. And I know that is an idea sounds so foreign to everybody right now at this point in the market cycle. However, but I will tell you, I personally, as an analyst, got to live through 08 and 09, and I got to experience those, and those moments were very real. So that's kind of what we have baked into our downside potential. Maybe not exactly that draconian in every scenario, but something similar to that. So as I mentioned, with that as a backdrop, our job each and every day is to maximize reward, minimize risk in the portfolio. So today in our mid-cap value strategy, we've constructed a portfolio that's fairly valued with downside potential in the high 40s. So that, from an absolute return perspective, is okay. Fairly valued doesn't mean we're investing to make zero. Fairly valued means that we think our portfolio, should compound capital, call it 8, 9, 10% a year, based on where the valuations are at in what we've invested our clients' capital in. That compares to our list that's more than 40% overvalued. So from an absolute return, that's okay. From a relative return perspective, what I would tell you is that 40% gap between our list and our portfolio roughly looks pretty attractive versus the history of Nuance. I went back and was studying this the other day. The difference between our mid-cap value portfolio and our list has averaged around 30% since the inception of Nuance. It's been as tight as 15% relative opportunity, and as wide as around 45. So today, being in that gap of roughly 40% or low 40s looks pretty good versus history. So, that's our job. We can't control how expensive or how inexpensive our list of 250 gets. Our job every day is to make sure that we've got the most possible upside with the least amount of downside each and every day, and we feel pretty good about how we're positioned today.
Chad, thank you so much for reviewing Nuance's risk-aware investment process. It was great speaking with you.
Hey, my pleasure, and it's just great to speak with you today.
Hey, Aaron, thanks for joining us.
Hey, Jason, great to be back.
So the addition of the Nuance Mid Cal Value Fund to Align and to our rec list resulted from one of AMR's unique due diligence processes. I was hoping you could speak a bit about mosaic calls and how they helped to discover Nuance.
Yeah, absolutely. I think it's an interesting story and one that shows both the depth of our process and also our knack for finding great investment managers like Nuance before they've already become household names. So it's pretty common for us to know an investment manager for several years before we invest. And in this case with Nuance, that went back to 2014 when we were conducting mosaic calls for another fund, American Century Equity Income, which at the time we were considering for Align's large cap value sleeve. And the reason those are related is that Scott Moore, founder of Nuance, was a portfolio manager at American Century before he left the firm and ultimately founded Nuance. So mosaic calls we feel are a valuable part of our process where we reach out to former portfolio managers, former analysts, potentially other former employees after they've left the firms that we're evaluating. And we hope in doing so that we're able to get unbiased feedback from them about their experience. So depending on circumstances for somebody's departure, one might still need to take that feedback you get with a rather large grain of salt in some cases, but in most cases, what is said or what is not said and insights that are shared can really speak volumes. So the term mosaic call, I mean, think of mosaic as the full picture, or in other words, the reality that we're trying to uncover of whether or not a fund can deliver alpha for clients. So our objective with our research process is to see as much of that mosaic as possible, turning every stone and going beyond that first, second, or third tier of more readily available information. So what we gain from these discussions might give us that last vital piece of the puzzle to help us identify fund strengths or potentially funds flaws. So I think this is really a great example as well for how our team goes far beyond the sort of check the box due diligence, if you will, that unfortunately has become pretty commonplace across our industry. And beyond that, I mean, these types of discussions and connections that we're having, like in this case with American Century and Nuance, it gives us insight into new ventures that are being launched by veteran investors who decided for whatever reason to strike out on their own. And it helps us gain insight into those opportunities long before their new fund hits everybody's 5-year performance screens and before portfolio managers are showing up and Barron's and they're getting their glamour shots for press releases and whatnot. So when we spoke with Scott Moore, Nuance's founder, back in 2014, I mean, right off the bat, I was really impressed by his passion for investing and his incredibly deep knowledge for every stock in their portfolios. And at the time, the Mid Cap Value Fund had really just been launched, and having less than a year of performance history, there wasn't a lot to go by if somebody was only looking at that fund, but it leveraged basically a less constrained version of the process that had made Scott Moore successful as a PM at American Century. So not long after those initial discussions that we had with Moore and Nuance, they decided to hire Chad Baumler from American Century, who you just heard from in this podcast, to be co-PM with Scott Moore. And we already knew Chad pretty well as we followed the team in American Century, and he was very well regarded there. We were impressed by him and his stock picking and leadership abilities. So recruiting him really went a long way towards alleviating some of the key person risk that you get with a more entrepreneurial, smaller investment firm like Nuance in its early days. So over the next few years, we kept in close contact with Nuance and kept reading their commentary, having calls periodically, and we considered it to be a strong bench candidate in the mid-cap space. And, over those next few years, it continued to post strong performance, and the firm grew to a point where it was de-risked from an asset under management standpoint. So then fast forward to late 2018, we had an opportunity to add a fund to mid-cap sleeve and align. And, most wouldn't consider the timing of our asks for on-site visits, in the last week of the year to be ideal for the sort of extensive reviews that we have, where an investment team, we're basically grilling them on all aspects of their process in person. But Nuance didn't bat an eye when I suggested December 27th as a date for that on-site review, and fitting that in before year end, it helped us to move along in our search. And long story short, it ended up being a great on-site. Everybody on the team was obviously very engaged, and it gave us that last piece of the mosaic, speaking with everybody there, and having that in-depth on-site discussion. And subsequently, we added the fund to Align just a few weeks later. So, hopefully that paints a picture for how we leverage our relationships with people for deeper research insights, and in some cases also how that helps us identify what we feel are really underappreciated gems like Nuance and others, in fact, for the Align portfolios.
Yeah, Aaron, that was really helpful and great way to highlight the mosaic calls that we do as a team. I think they add a lot of value to the process, and they really are a bunch of fun for us analysts. So thanks for hopping on and speaking with me.
You bet. My pleasure as always.
Well, what did you think? It was amazing to get Chad on to discuss risk in this market. I also hope you enjoyed the after show where Aaron discussed the importance of AMR's mosaic calls. We appreciate your feedback as we continue to create premium content. Are there any other Align managers that you would like to hear from? What additional content can we produce for you? Reach out to AMR and we'll be sure to respond.